Yo, what is up, folks, family, and future millionaires? It is your boy DD01 back again, and today we are diving straight into the deep end of the macro world because things are moving incredibly fast, and the global financial system is shaping up to be absolutely wild as we crawl closer to June 2026. I remember sitting at my desk back in 2020, right after graduating college into a completely broken world economy, looking at my empty bank account and feeling that absolute pits of your stomach panic about the future, thinking to myself, oh shit. How am I ever supposed to build real wealth or protect my family when the entire global financial system feels like a rigged house of cards run by complete clowns? But that scar taught me the ultimate lesson, which is that chaos is a ladder, and if you know how to read the macro trends and spot where the biggest players are moving their money, you can build an absolute financial fortress for yourself while everyone else is running around panicking. Right now, the mainstream media is screaming at you about inflation, and the European Central Bank alongside the Federal Reserve are gearing up to overreact to rising oil prices by aggressively hiking their benchmark policy rates. But I am telling you right now that this entire situation is a massive, carefully disguised trap. Even over there in Europe, where central bankers as a group tend to be way more aggressively hawkish than anywhere else on Earth. Several top officials have quietly come forward recently expressing serious and growing concerns about the collapsing demand side of the economy, especially where it comes to disappearing jobs and struggling everyday workers. And to that exact effect, fitting perfectly with that grim sentiment, two of the world's absolute leading energy agencies just completely slashed their global demand growth forecasts in a terrifying way that we only ever see in dark macro periods like 2020 or the 2009 Great Financial Crisis. Worldwide, the initial structural indications, especially where it comes to the softening labor market, are already beginning to look exactly like a historic energy shock case. And it is happening so fast that even central banks are starting to desperately reassess what the real underlying risk to the global economy truly might be. Now, if you listen to their public speeches, they still claim by and large that the fight is all about sticky inflation. But we are getting more and more concrete indications on the other side of the ledger that suggest otherwise, and these red flags were just greatly aided by the latest forecast from the U.S. Energy Information Administration, which just brutally slashed its energy demand estimate to basically zero for this year. And if you think that is bad, its international counterpart, the International Energy Agency, went even further into the dark, saying it now officially believes global energy demand will outright shrink and contract this year. Now, you have to ask yourself, when was the last time global energy demand actually shrank? The answer is 2020. And before that, 2009, which means the elite data agencies are literally predicting a synchronized global economic shutdown, while the stock market is sitting here partying at the highs. There is one critical macro factor in all of this madness that most everyday people completely overlook or just completely dismiss, including central bankers and certainly the retail crowd in the stock markets. But that factor is really beginning to be way too massive to ignore anymore. That is the actual fragile state of the global economy before this current energy shock even began. And that is exactly where the hard data and empirical evidence is making a huge difference right now already. So while everybody on your social media feed is talking about inflation and expecting endless rate hikes from central bankers, we have got a whole bunch of undeniable data points on Europe, but also structural oil demand that suggests this whole train is moving toward the historic energy shock case. Because if you go back and take an honest look at Europe, it really was not long ago that their entire manufacturing sector was deep in recessionary territory. Looking like a financial crisis level event, particularly over in Germany, it was just like every single month the data got worse and worse, companies were laying off workers left and right, and then the government steps in and says, hey, everything is fine, we are going to do some massive military spending packages, and everyone got temporarily excited, like yes, this is exactly what we needed, the economy is going to turn around. Then the oil shock hits and you get a lot of artificial front-running of demand, and we see that exact same psychological phenomenon playing out right here in the US, where all of a sudden everyone is screaming about a factory renaissance, saying everything is going to be totally okay and booming. But there is this massive underlying problem that nobody wants to talk about. You do not see actual hiring. What you are actually seeing under the hood is just a temporary pickup in hours in some specific cases and some artificial optimism where a few factories are saying, hey, maybe this will get better next quarter. But they are absolutely not reacting with the labor market because they refuse to hire new full-time employees. And I think this is a massive structural problem Europe is facing right now because they have already laid off so many people, and their management teams know deep down that consumer demand is going to come down hard because of inflation. And yes, is this current energy situation going to be inflationary in the short term? Of course it is, because prices are going to go up around the world, and we are seeing it clearly at the producer level, the intermediate level, and it is spilling directly over to the consumer level, meaning your daily cost of living is going to go higher. But you have to understand the massive difference between the right kind of inflation, which is demand, led because people are getting richer and spending more, and the absolute wrong kind of inflation, which is supply-driven energy inflation. And that is the exact nightmare problem here because prices are going to go up, corporate profit margins are going to get absolutely squeezed, and consumers are going to violently pull back on their discretionary spending. We see this exact macro movie replay time and time again throughout economic history, and we know exactly what it means for your wallet, which is that companies are going to be forced to lay off staff. They are eventually going to cut working hours, and you start to sow the seeds of a deep economic downturn. It is pretty obvious where Europe's economy is headed right now because 4 out of the last 5 US recessions were explicitly triggered by these exact types of energy shocks. How Europe comes out of this situation even remotely unscathed, I have absolutely no idea, but it sure looks to me exactly like they are heading straight into yet another devastating recession. And of course, we know the ECB is going to do what they always blindly do, which is raise interest rates right out into the teeth of this recession. Just like they disastrously did back in 2008 once, and then twice in 2011 right before that major euro crisis started too. It honestly seems like a highly specialized talent you must have to sign up for. Or you must have to demonstrate a unique talent to raise interest rates into a collapsing recession in order to get a top executive job at the ECB, because it must be part of their official job requirements. But the absolute core issue here is employment. Because we are seeing an increasing amount of highly negative employment indications flashing across Europe, which is the one specific thing that will eventually get the central bankers' desperate attention. What they are going to say publicly is, look, inflation and oil prices go hand in hand. Therefore, we need to hike rates to cool things down. And the only thing that actually convinces them that they are dead wrong is when the official unemployment rate starts to aggressively rise. And when unemployment rises, even before you get to the full impact of higher energy costs, then you got to say, oh boy, wait a minute, the global economy was supposed to be picking up into early 2026. And everything was supposed to be already turning around nicely. Instead, we see it clearly in European GDP and various employment numbers for particular major countries, like France, which has had negative payroll numbers for 2 years, running now, pushing the unemployment rate up to a staggering 8.1% in France alone, even across the entire euro area. Total employment growth has officially slowed down to basically nothing, with the year-over-year change in employment across the euro area sitting at a miserable 0.5%, which is well within historic recession territory. So if you are an honest ECB official, you are sitting at your desk thinking, wait a minute, the entire labor market across Europe, but especially in the engine economies like Germany and France, was already weak and getting weaker before we even got hit with this current energy shock. We know exactly how the energy shock plays out because energy shock and recession are two phrases that use the exact same sentence structure because they almost always go together throughout history. So now all of a sudden the ECB is starting to panic and say, look, we have been talking big about hiking rates to fight inflation, but now we have to maybe think about this a little bit more than we thought we would have to because we are already getting horrific indications in sentiment data, suggesting the historic recession case is already playing out across Europe. Now, you guys know I almost never do ads on this channel, and I say an absolute no to the vast majority of sponsorship deals that are brought to my attention because I refuse to push garbage on my community, but I was honestly thrilled to be able to work with today. Video sponsor Monetary Metals, and the reason is because they are actively solving a massive structural problem, one that I have been highlighting for a very long period of time on this channel. Gold is undisputedly the ultimate safe haven asset when the global economy is crashing, but other than sitting quietly in a dark vault costing you storage fees, traditional gold does not actually do anything for your cash flow. Monetary Metals completely fixes that flaw because they actually let you earn real yield paid to you in physical gold without ever giving up your legal ownership of the asset. It is not a sketchy fund, it is not a paper claim or a weird digital token. It is your actual physical gold working for you in the real world. Every single month, more physical gold gets deposited directly into your account, making it simple, completely transparent, and it is fully insured if you believe in gold as a vital long-term store of value to protect your family from central bank inflation. Just like I do, this completely changes the entire investing game. Go to monetarymetals.com/NDR, that is monetarymetals.com/NDR for all the details, and to claim your shield, and we absolutely thank them for backing the channel and sponsoring today. Video, so now let us get straight back into the data. Yeah, the reality is that central bank players all around the world really did desperately want to hike rates over the past year. And of course, we know their narrative games do not actually matter too much to the real economy, but everybody wanted to bring rates up because they knew deep down the economy was fundamentally weak. See, if they could artificially force interest rates up while things looked okay, then they would have a built-in excuse to bring them down later and say, hey, look, we are the heroes saving the world by lowering interest rates. But the massive problem right now is that rates are still relatively low in the grand scheme of history. So even if they bring them back down to zero, the actual stimulative impact it is going to have on an economy that we already know is structurally broken is going to be absolutely nothing to begin with. But if you are a central banker trying to convince the world that your policy makes a magic difference, you have got absolutely zero margin for error right now. And this is exactly why you hear central bankers all around the world sounding incredibly nervous whenever they speak at public forums, because this is going to be one of those clear-cut times where they are going to do what they always do, which is cut rates, start printing money with quantitative easing, or maybe magically try to come up with some weird new policy tool that they can brand, and it is simply not going to work. And the ultimate problem is that their institutional credibility, which for you and I is already pretty much at zero, but for the rest of the world remains relatively high, is going to be absolutely destroyed during this cycle. One thing you can do to see the truth is look directly at the marketplace, meaning you can look at bond curves and yield curves, but you can also look at forward interest rate markets like your Euribor futures, which are the euro-denominated twin to the SICO futures that I covered not that long ago. In the futures pricing, you can see a massive frown in the curve, which is the market's explicit expectation that some central bankers, including the Federal Reserve, might actually be able to bully rates up in the near term, but eventually they are going to have to turn around and aggressively lower them again. That is the exact frown that the curve shape has taken, and what it is telling you is that European central bankers are highly likely to raise rates in the short run, but like everyone else around the rest of the world at some point, they are going to have to turn around and drop rates like a stone. Now, the Euribor futures curve was already completely inverted before we even got to the end of February. Well, before the latest round of global conflicts showed up in the news, the fact that it was inverted suggested that before the energy shock even began, institutional participants in the marketplace realized the underlying situation in the real economy was absolute garbage. Central bankers absolutely hate having low interest rates facing economic weakness because they want to be able to say, look, we just cut rates by 400 basis points. Look at this massive economic stimulus we are providing to the public. But if you are already stuck at a low rate and you are facing a massive macro downturn, you do not have enough altitude in your interest rates to make a difference, and the market is pricing in rapid rate cuts by the ECB because of substantial structural weakness. Then you throw in higher energy costs, probably followed by higher food costs, which we are already starting to see at the grocery store, and a whole bunch more of economic difficulties like businesses laying off workers and a continuation in the deterioration of employment. And you realize rates are not going to get high at all before the system breaks. So the real question you need to be asking yourself is, when do you see enough weakness in employment data that central bankers are forced to stop hiking rates? And what the data is showing us right now is that some of these central bankers, especially in Europe, are already having that exact same quiet discussion behind closed doors. And honestly, that is a bit of a surprise because historically, the ECB's only move is to hike rates blindly and then say whoops when everything breaks. Why the curve is saying that rates might go higher in the immediate short term is simply because of raw inflation data, and we are seeing some signs that consumers are absorbing the higher costs for now, but we know they cannot do that indefinitely. We know that over here in the US, people are drawing down their last remaining savings and relying on temporary tax refund checks. But when you look closely at the recent retail sales report, where did we see the only growth energy in food? That is a massive red flag, because it means for the average worker and for the average household all around the world, all of their hard-earned money is going purely to food and gasoline, leaving absolutely nothing left over for the rest of the economy. So what the curve is trying to tell people very clearly is that consumers are going to get completely bogged down with inflation, especially since average hourly earnings just went negative due to inflation for the first time in 4 years. As consumers spend more money on basic food and energy, which shows absolutely no signs of coming down in the near future, that means at some point they are going to have to brutally cut their discretionary spending. As that lack of spending back flows through the entire economy, we are going to see hours get cut, jobs lost, and the economic fundamentals of growth are going to start turning down fast, leaving central bankers playing a desperate game of catch-up. You see, central bankers have the ability to influence short-term rates, and they are terrified of what they call second-order effects. They are worried that when gasoline costs go up, all of these businesses in the economy will see their input costs rise and adjust their prices, creating a broad-based, deeply entrenched inflation spiral where consumer expectations become unanchored. But what the market is screaming right now is that is not how this works, because the economy is not experiencing a demand-side increase where incomes are rising and the job market is robust. This is higher oil prices for non-economic, geopolitical reasons. And the only way the world can respond to it is not by passing costs along to customers who cannot afford it, but by cutting demand everywhere else. Even mainstream economists are starting to get cold feet on this, with senior analysts noting that we are already seeing massive weakness in the economy that will naturally dampen inflation pressures and lower the risk of second-round effects. So the probability of endless rate hikes is rapidly diminishing because we are seeing more visible weakness in the real economy. And we are only a couple of months into this energy shock, which is a horrible sign. If you look back at prior energy cycles where we have seen these sudden price spikes in a weakening or slowing economy, it typically takes about 2 months before you hit the absolute point of no return. We are now past that 2-month mark, and the reality is that consumers cannot afford this. Businesses have no choice but to absorb the costs until they break, and central bankers are going to hike rates right into a brick wall and then immediately be forced to cut them as the economy slams face first into a recession. The U.S. Energy Information Administration just stated that we are looking at just 200,000 barrels a day of demand growth for this year, which is absolutely anemic for a global economy and consistent with a full-blown synchronized recession. The International Energy Agency went even farther, forecasting negative demand growth of minus 420,000 barrels a day. A metric you only see in the absolute worst-case scenarios for the world, like 2020 and 2009. What they are saying is that regardless of oil supply, because prices are so high and the economy is weak, energy demand is going to fall off a cliff, which is a huge red flag because oil is relatively price inelastic.